Welcome to our credit reports and scores video. My name's Mackenzie at First Commonwealth Bank, where it is our mission to improve the financial lives of our neighbors and their businesses. Today, we are going to discuss credit scores and reports. We will also talk about two most important things you can do for your credit score and why your credit score matters. A credit report is a detailed summary of your credit history prepared by a credit bureau. The three major credit bureaus are Equifax, TransUnion, and Experian. While there might be slight differences between your credit reports from each of these bureaus, all reports contain potentially negative credit information, positive credit information, credit inquiries, and personal information. Let's look at each of these in a little more detail. The section with potentially negative credit information will list if you are more than 30 days late with a payment on any credit accounts, like credit cards or any type of loan. It'll also list bankruptcies, foreclosures, repossessions, and accounts that have been turned over to collection agencies. An example of this would be if you did not pay a cell phone bill. Typically, outstanding bills are turned over to collection agencies after they are more than 90 days overdue. Loans that were not paid back as agreed will also appear as potentially negative information. In the section with positive information, you will see all of your credit payments that have been made on time. You will also see past loans that have been paid off as agreed. For example, if you paid off a car loan without any late payments, it will show how much the loan was, what the payments were, and when you paid it off. Both positive and negative information stay on your credit report for a period of 7 to 10 years. The credit inquiry section shows to whom and how often you apply for credit. If you apply for a credit card or a mortgage pre-qualification, for example, the lender will review your credit report and score to determine if they want to extend the loan to you. It will also show if banks and other finance companies are pulling your credit to see if they want to extend pre-approved credit offers to you. But these types of inquiries will not impact your credit score. In the credit score section, we will talk more about the different types of credit inquiries and the effect they have on your score. The last section of your credit report has personal information, such as the last 4 digits of your Social Security number, your birth date, current and previous addresses, and your name and maiden name if applicable. You can get a copy of your credit report from each of the 3 major credit bureaus for free once a year. You can get it at www.annualcreditreport.com. Federal law allows you to get a free copy of your credit report every 12 months from each credit reporting company to ensure that the information on all of your credit reports is correct and up to date. Credit scores are designed to evaluate how big of a risk it would be to lend you money and are determined based on the information on your credit report. If your score is low, it's because your credit history suggests that there's a higher risk that you'll default or not pay a debt back in full. It can also be low because you don't have a credit history or very minimal history to determine your score. If your score is high, it is because the positive information in your credit history suggests you will continue to pay your debt on time and in the future. There are many types of credit scores, but 2 of the most commonly used are FICO and VantageScore. Both scores range between 300 and 850. FICO scores are used by the vast majority of lenders. In fact, FICO generates 49 types of credit scores for lenders. each focusing on a different lending requirement for a variety of financial providers in the United States. Each of the big three credit bureaus generates both the FICO score and Vantage score. The information reported to the credit bureaus isn't shared between them, which may lead to different scores. In addition to that, credit scoring companies routinely update their formulas. Some lenders may rely on older versions of a FICO score or Vantage score, which may further lead to differences between scores. However, these differences shouldn't be too far apart from each other and should generally fall within the same range. If, however, you find big differences of 50 to 100 points or more, then you should review your credit reports to find out what's triggering that difference. It could be as simple as a credit card account not being recorded by one credit bureau, or a late payment recorded by one credit bureau but not the other two. Know that when you check your credit score, it's a snapshot in time. Your scores rise and fall depending on lender-reported activity, such as payments, balances, accounts opened or closed, and more. Usually, credit scores range between poor and excellent. FICO scores are considered poor if they are below 579, fair if they are 580 to 669, good if they are 670 to 739, very good if they are 740 to 799, and exceptional if they are above 800. There are 5 factors that go into calculating a FICO score, but they are not all equally important. Let's take a look at what they are. The most important factor in your FICO score is your payment history. It accounts for 35% of your score. This refers to your ability to pay every credit card and loan payment you have on time every month. If you are more than 30 days late making a payment, it will negatively impact your score. The later you are, the more it'll impact your score. If an account is turned over to a collection agency, it'll lower your score, as will having to file for bankruptcy. Credit utilization is almost as important as your payment history. It accounts for 30% of your score. Credit utilization refers to the dollar amount of your debt, but also how much debt you have in relation to your available credit. Let's look at an example. If you have a credit card with a $2,000 limit and you have a balance of, say, $800, it means you're using 40% of your available credit. Typically, the closer your balances on credit cards are to the limit, the bigger negative impact it'll have on your score. It is ideal to pay credit cards in full each month, and if you do have to carry a balance, try to keep your credit utilization under 30%. That means you should strive to carry a balance of less than $600 on a card with a $2,000 limit. Length of credit use refers to the length of time you have been using credit. The longer you have been using credit, the better. This is one of the reasons why it is important for people to responsibly establish credit as soon as they can, so that they can start building a credit history. Credit mix means that you are responsible with different types of credit, and it'll impact 10% of your score. Examples of different types of credit include payments that stay the same each month, like a car loan or a mortgage, and payments that can change each month, like a line of credit or a credit card. No matter what type of credit you have, it is key to make your payments on time to maintain a good score. How often you apply for credit accounts for 10% of your score. It is not impacted if you look at your own credit score or credit report. Your score is only impacted if you actually apply for credit. This is called a hard credit inquiry on your report. It means a financial institution is reviewing your credit report and score to determine if they are going to extend you credit. If a financial institution wants to send you a pre-approved offer for credit, they will also look at your score, but this is called a soft inquiry, since you did not initiate it. Soft inquiries are also used if an insurance company, an employer, or a landlord runs your credit. Soft inquiries do not impact your score at all. Your credit score is based on the information on your credit report. So the way to improve your credit score is to have more and more positive credit information on your credit report. The most important thing is to pay each bill on time each month. If possible, pay off credit card bills each month. If that is not possible, the second most important thing you can do for your credit score is strive to keep your credit utilization below 30%. Make it a priority to pay down high balances on credit cards and lines of credit. It is also important to only apply for and use credit as you need it. Do not apply for loans or credit cards you don't need just to get a percentage off your purchase or coupons. Many companies, including First Commonwealth, will provide your credit score for you for free if you use their products. If you have a First Commonwealth Bank credit card, you will get an updated score on your statement each quarter. Remember that your credit score can and will change over time. It is completely normal for a score to go up or down by a few points from month to month, even if there is no major changes on your credit report from one month to the next. Your credit score matters because having a high score means you'll have access to credit at a lower cost. Access to credit means you'll be able to borrow money for large purchases like homes, cars, and education. It also means you'll have the ability to borrow money for emergencies or fun things. Typically, the higher your score, the lower your interest rate will be. This can make a huge difference over time. Many landlords also pull credit reports and require a certain credit score to be able to rent an apartment. It can also impact your insurance rates, and some employers will review your credit report before offering you employment. You do not need a perfect credit score to be approved for a loan, but knowing what goes into a credit report and how a credit score is calculated will help you make decisions every day to improve or maintain your score. Thank you so much for joining us today. To give us feedback on this video and be entered to win a great prize, please take a quick survey by scanning the QR code or visiting the site listed on the screen.